Welcome, ladies and gentlemen. This is Lesson 3, Preparing Journal Entries from Common Business Transactions, Income Statement. Not to try and get original on you guys, but let's talk about what we're going to discuss. What we're going to discuss is preparing journal entries from common business transactions, but specifically related to the income statement account. Like I said, accountants, we're not creative, so the title is basically what we're going to cover. So remember from Lesson 2, we went through some pretty important concepts, and so if you haven't seen Lesson 2 yet, I'd go back to Lesson 2 because the important concepts of journal entry, general ledger, transaction, how to record a transaction, debit, credit, those are concepts that we're going to need to understand before we move on to this lesson. So if you haven't seen Lesson 2, please go back to Lesson 2. If not, let's move on, and then we're going to discuss some other really important concepts that are going to follow us throughout this journey on this sailing ship that we're going to be on with HMS Roundbelly. These concepts are going to follow us throughout. So let's move on to the concepts. First concept to understand is cash basis accounting does not equal GAAP. Alright? I'll read the definition because this is a pretty important concept, but just understand cash basis accounting does not equal GAAP. Cash basis accounting records revenue when cash is received and expenses when cash is paid. Now remember from Lesson 1, I talked to you about cash doesn't necessarily need to be exchanged for us to recognize the revenue, and cash doesn't necessarily need to be exchanged for us to recognize an expense to get to the income statement. On the statement of cash flows, yes, we're only looking at cash, but for recording revenue, recording expense, it's not cash basis. We can record a transaction even if cash hasn't been exchanged. Goods and services need to be exchanged for us to record a transaction, but that goods and service doesn't necessarily need to be cash. All right, pretty important concept, actually very important concept to understand. Because remember from Lesson 1, GAAP is the grammar. GAAP is the correct way to present the financial statements. So if it's not GAAP, it's not right, and you have to go back and fix it. But if it is GAAP, it's right, and then we can move on. So cash basis does not equal GAAP. But what is GAAP? Well, if it's not cash basis, what kind of basis is it? It's accrual basis. I'll read you the definition of accrual basis because it's very important. Accrual accounting records revenues when they are earned and expenses when they are incurred, regardless of the timing of cash payment. All right. So revenues when they're earned, expenses when they're incurred. Doesn't matter when cash is exchanged. All right. So let's move through here, and you'll see on the bottom right here concepts and definitions. We're going to move through these important concepts and definitions before we go on to actually looking at transactions. So revenues are earned when goods or services are provided to customers at a determined price and when with reasonably assured collection. All right. What does that mean? Okay. Well, I can't recognize revenue. I can't say I'm going to receive cash. Remember back from Lesson 1, the business cycle of, say, a servicing company is provide services, receive cash, and then we incur operating expenses, provide services, receive cash. Well, if we provide services and we know we're never going to receive cash, well, that's really not a revenue transaction. That's just a loss of assets. Or loss of time. We've just lost the services, and we're not going to get anything back. Pretty bum deal. But we can't recognize revenue unless we know we're going to get something back. All right. Expenses. Expenses are incurred when the economic benefits of an item are used in the current period, resulting in a decrease in the company's resources. All right, what does that mean? The economic benefit and period recorded. Okay, we can pay for an asset now and use it later, like insurance. You pay for insurance now to be covered in 6 months. All right, so that if we're paying for it now, but we're going to get the benefit later, all right? We record it as an asset because that's something that's going to provide a benefit later, but we don't recognize the actual expense until we've used that benefit, until that resource is no longer available to us, right? So until that economic benefit has been used as an asset, but once we use that benefit, it's an expense, all right? Even, see, and that's the thing about cash, we already paid cash, no expense, but cash doesn't get paid, but we use the benefit, expense is recognized. Cash basis wouldn't work that way. Cash basis, you expense it as soon as you paid it. That's not GAAP. GAAP says you have to use it when the economic benefit is used, not necessarily when the cash is out the door. Important concepts. If it doesn't make sense, watch this lesson again. I'm going to keep going, but these are very important concepts. All right. Expense versus expenditure. This goes a little bit more in depth onto what I was just talking about the insurance. An expenditure is when cash actually leaves. In expenditure, cash leaves the door. Expense, benefit is used. benefit is used in an expense. Expenditure cash is out the door. We can have capital expenditures, where we pay cash for capital investments like property, plant, and equipment. Capital expenditures doesn't necessarily mean we're recognizing expense, because that expenditure is just cash out the door, but there's no expense related to it because we're getting something in exchange, right? All right, so I'm going to read this because it's really important, and follow along. But if I go in too fast, you can just rewatch the lesson. An expense is the cost that results when a company sacrifices its resources by using up its assets or incurring liabilities to generate revenues during the accounting period. Expenses can be incurred by spending cash, using up another asset, or incurring a liability. They don't always involve an immediate outflow of cash. On the other hand, expenditures are any outflow of cash for any purpose, whether to pay down a bank loan, buy some land, or pay an employee. Right? So expenditure is any cash outflow. Expense is only when we're using assets or resources. Right? We're using that. We're expensing it. Revenue recognition principle. All right, so you follow the top. That revenue arrow goes over the revenue recognition principle. Revenue recognition principle says the revenue principle is a concept that requires that revenues be recorded when they are earned rather than cash is received. Right? Cash basis versus accrual. Accrual is GAAP. Cash is not. Revenue is recognized when we earn it, right, rather than when we receive cash. Matching principle. Big concept. Big concept in accrual accounting, matching. We need to match revenues, match expenses. The matching principle is the concept that requires that expenses be recorded in the period which they are incurred to generate revenue, rather than the period in which they are paid. What does that mean? Okay, if I'm selling a good, all right, the cost of that good needs to match when I recognize that revenue. So if say I give a product to a customer in December, I give them that product, right? So I need to recognize the expense. I'm giving up the asset. Well, I also need to recognize that revenue at the same time as I'm giving that expense. I need to match the revenues with the expenses. Recognize revenue when I recognize the expense, all right? Just understand the concept. It'll make more sense as we go through specific transactions. All right, now that we've gone through those concepts, let's look at the chart of accounts. Similar to lesson 2, where I went through the chart of accounts for Roundbelly. For the balance sheet, this is the income statement chart of accounts. Typically you see them together. I've broken it out just for ease of discussion here. But so the chart of accounts, you see up here in green, we got the revenue accounts, and that'll flow into our income statement on the revenue line item. We got expenses here in this sort of pink reddish. Those are expenses, and those will go to the income statement under expense, or operating expense, cost of sales. Either way, it's going to go onto the income statement under expense. It's going to be subtracted from revenue. And then down here below, you got these gains and losses. I don't know if we're specifically going to get into any gains and losses, but conceptually understand that gain is, say, like the inflow of investing. When you sell property or equipment, well, you could make a gain on that. Say you bought it for this price and you sold it for more. Okay, well you're gonna recognize a gain. Or say you bought it for this price and you sell it for less. Well, you're gonna recognize a loss. All right. So those gains and losses are transactions that occur that aren't part of our primary business. They're secondary transactions. They're peripheral transactions. They're not part of Roundbelly's operating activities. They're not the day-to-day production, manufacture, sell goods, incur expenses. These are stuff that happens that are not part of the operating activities, the day-to-day activities. Those are gains and losses down here. All right, so I'm not going to go over this too much and explain to you exactly how it works, because I explained exactly how it works in Lesson 2. If you haven't seen Lesson 2, go back and watch Lesson 2, because the concepts flow forward, really important. All right, let's go over here to the right-hand side of this cheat sheet, and I want to explain to you a concept briefly. This may not sink in. When I was learning accounting, this didn't sink in for a long time. So if it doesn't, go back, review it a couple times. But basically, this is what we're saying. How do revenues, expenses get to the retained earnings on the balance sheet? Okay, this is important. What's the basic accounting equation? Asset equals liabilities plus stockholders' equity. All right, stockholders' equity. So basically, what is stockholders' equity? Stockholders' equity is contributed capital, right? Say I sell stock, I sell shares. Okay, so capital's coming in. I'm giving shares. I'm giving them just paper, but I'm getting $75,000 in, as was the example in Lesson 2. So that cash is coming in. That's contributed capital. That's capital I can invest now and use in my operations. All right, so stockholders' equity is made up of contributed capital and retained earnings. All right, and what's retained earnings made of? Retained earnings is made of revenues less expenses, right? So we got our income statement, revenues minus expenses. Remember in lesson 1 I showed that flowed through the statement of retained earnings, plus beginning retained earnings plus net income less any dividends. That is our ending retained earnings. Ending retained earnings flows up into stockholders' equity. It flows up into the basic accounting equation, assets equals liabilities plus stockholders' equity. So even a revenue expense transaction somehow flows into the basic accounting equation. That's why I said that equation is so important. It's going to follow us throughout. Assets equals liabilities plus stockholders' equity. Even revenue expense transactions, which are included on the income statement, somehow work their way up there. Follow the flow chart here. You'll see how they get there. Very important concept. We're going to move on, though. We're going to get to some revenue transactions, and then in lesson 4, I'm going to show you how to make the journal entry to get there, but we're not going to cover it now. Another important concept, accrual accounting for expenses. All right, expenditure versus expense. Okay, so cash goes out the door. Cost is incurred. We pay something. All right. Question: if benefit is for future period, record an asset, prepaid insurance, right? Remember, I'm paying for insurance policy now, but it's going to benefit me for 6 months. All right, that's a future benefit. So that's an asset in the future. Because I'm not receiving the future benefit now, so I record an asset. Well, the other question, if no benefit for the future period, say I wasn't going to receive any benefit for that cash, well, I'd recognize an expense. All right? But as I use that asset over the life, I expense it, right? That comes down here, expense. So this is a little question you can ask yourself as we go through on the other side of the transactions. Cost is incurred. Okay, does it benefit your future period? If yes, record an asset. If no, expense. How do we get that asset to the expense? Well, as we use as we receive the economic benefit of that asset, we record it as expense. All right, let's flip the cheat sheet. We're going to go through some transactions, give you a little bit more detail. Now, okay, here we go. Revenue transactions occurring in September for Roundbelly. All right. A. Provide boat repair services in September to customers for $20,000 cash. Stop. Remember, accounting's easy. Transaction. Did a transaction occur? Yes, we provided repair services, goods, services, resources exchanged. We provided services. Transactions occurred. Yes. Okay, so we're going to move on. What accounts? Well, let's think about this. We provided a service. So service, remember, use service, receive cash, service, revenue. This is service revenue, all right? So, and how do, I didn't discuss this, but going back to the accounting page, revenues increase on the right. Revenues increase with the debit. They decrease with the, they increase on the right. They increase with the credit, decrease with the debit. Sorry, I'm going to get this right sooner or later. All right, revenues. Revenues increase on the right with the credit, decrease on the left with the debit. Expenses, opposite. Expenses increase with a debit on the left, decrease with a credit on the right. Now, okay, so getting back. Boat, A, we provided boat repair services in September to customers for $20,000 cash. All right, so what do? We received cash, right? Resources exchange, cash, credit, no, cash increased, debit.